Welcome to This Explainer. Today, we're diving deep into Ryder System's second quarter 2026 earnings report. We're going to see exactly how their transformed business model is actively navigating the current market cycle. We'll cut straight through the dense financial data, break it all down, and give you exactly what you need to know.
CEO John Diaz didn't mince words when kicking off the quarter, highlighting Ryder's seventh straight quarter of comparable EPS growth. Just think about that track record for a second. Delivering consistent, apples-to-apples profit growth for nearly 2 full years, especially in a logistics environment that's seen plenty of recent volatility, well, that's no small feat. It sets some very confident momentum for what we're about to unpack.
Here's our roadmap for today. 1. Q2 2026 earnings snapshot. 2. Driving profit fleet management. 3. Supply chain and dedicated. 4. Cash flow and capital. And finally, number 5, the full year 2026 outlook.
All right, let's jump right into section 1. Q2 2026 earnings snapshot.
To start us off, Ryder posted a massive $3.3 billion in total revenue for the quarter. That's a solid 5% bump from the prior year. But here's the real kicker. Their comparable EPS shot up 12% to $3.73. So they aren't just making more money on the top line, they're incredibly efficient at keeping more of it. Translating revenue into higher earnings like that is exactly what you want to see in today's macro environment. To see where that $3.3 billion is coming from, we just need to break down Ryder's 3 main engines. It's an incredibly balanced pie. You've got Fleet Management Solutions driving 43% of the revenue, with Supply Chain Solutions right on its heels at 40%. Dedicated Transportation Solutions rounds out the portfolio at 17%. This diversification really is a core component of their ongoing resiliency. Moving right along to Section 2, Driving Profit, Fleet Management. When we peel back the layers on Fleet Management Solutions, or FMS, there's a fascinating dynamic going on. Sure, total revenue was up 6%, but if you look at operating revenue, which strips out things like fuel pass-throughs to give a much clearer picture of the core business, it only ticked up 1%. You might be thinking, okay, 1% growth, big deal. But just wait until you see what happened to their earnings before tax. Despite that modest 1% creep in operating revenue, their earnings before tax absolutely rocketed. We're talking a 20% surge to $150 million. That is some serious margin expansion. How did they pull that off? It mostly comes down to impressive profitability in ChoiceLease, which is their core contractual leasing business, plus a massive, massive tailwind in the used vehicle market. Let's talk about those used vehicles for a second, because Ryder saw some serious sequential stability and year-over-year pricing increases. Used tractors saw a 3% bump in pricing, and trucks were up 6%. Management actually noted that these results totally outperformed their own expectations as market conditions strengthened. Selling used assets at a premium like that acts as a huge lever for their overall profitability. Let's pivot over to Section 3, Supply Chain and Dedicated.
Now, zooming in on Supply Chain Solutions, SCS, and Dedicated Transportation Solutions, DTS, the raw numbers fluctuated a little bit year over year. But the crucial takeaway from management is that both of these segments hit their targets. They delivered solid pre-tax earnings right in that high single-digit target range. They're generating highly reliable returns, even while navigating some pretty unique market hiccups this quarter.
It's honestly a classic push and pull story right now across the entire Ryder portfolio. On one hand, you have fantastic tailwinds, strong used vehicle pricing, big new business wins in supply chain, and highly optimized retail networks. On the other hand, they skillfully used those tailwinds to absorb some tough headwinds, like a sluggish automotive sector, the initial startup costs of ramping up that new SCS business, and a slightly lower overall fleet count over in DTS. So how did that shake out? Well, SCS saw operating revenue jump a healthy 7%, largely thanks to that new business, but their earnings dipped 7% to $92 million, mostly because of those automotive headwinds. Meanwhile, DTS navigated their lower fleet count, which caused a 3% drop in operating revenue, but they still successfully pulled in $36 million in pre-tax earnings. All right, let's talk about the wallet in Section 4, Cash Flow and Capital. For the first 6 months of the year, Ryder generated a whopping $684 million in adjusted free cash flow. To put that into perspective, they were at $461 million in the exact same period last year. That's a massive leap. A huge chunk of this cash generation comes from reduced cash capital expenditures, mainly due to them intentionally timing out their fleet replacements. And guess what they're doing with all that cash? They are aggressively rewarding their shareholders. Since 2021, Ryder has bought back a staggering 26% of their outstanding shares. Plus, they've hiked up their quarterly dividend by 74% over that same window, marking their fourth straight year of double-digit dividend raises. If that doesn't scream, we believe in our cash flow, I really don't know what does.
Now, you might be thinking, are they overextending themselves? Not at all. Even with all that capital going back to shareholders, their balance sheet is perfectly calibrated. Their debt-to-equity ratio is sitting comfortably at 259%. That's safely at the lower end of their long-term target range of 250% to 300%. So they've kept plenty of dry powder and financial flexibility for whatever comes next. Which brings us to part 5, the full year 2026 outlook. So what's next? Management is feeling extremely confident in their high-quality contractual portfolio, which actually led to some pretty exciting upward revisions for the rest of the year. Their strategic initiatives are on track to achieve $70 million in benefits this year, and you can absolutely see that level of operational efficiency baked right into their new targets. Here are the key numbers to remember. Ryder just explicitly raised their comparable EPS range to between $14.40 and $14.80 for the full year. They're also sticking to a powerhouse 18% target for return on equity, and they fully expect free cash flow to land right between $700 and $800 million. Overall operating revenue growth? They're holding that at a steady 3%, fueled primarily by the supply chain segment. I'll leave you with this to chew on. CEO John Dies emphasized that this transformed, highly resilient business model has seriously held its ground through a volatile cycle. So as freight market trends start to inevitably improve and this logistics giant really flexes its muscles, just how much upside is waiting to be unlocked when the cycle finally turns? It's definitely something to watch. Thanks so much for joining this explainer, and we will catch you next time.